Stop scrolling right now, because what I'm about to explain is the single most important financial story happening in the world today. And almost nobody is talking about it correctly. I'm not talking about inflation headlines. I'm not talking about stock market drama. I'm talking about the bond market, the $130 trillion monster that sits underneath everything else. And right now, that monster is showing signs of waking up angry. Before we dive in, quick favor. I'm running a campaign against copycat channels that steal content and confuse the algorithm. If you value real analysis, subscribe right now and comment Bond Panic so YouTube knows who the original source is. It takes 2 seconds and it helps more than you know. Right now, as I'm recording this, it's Friday, February 7th, 2026, and the exact time is 11 a.m. Drop your time zone in the comments because I want to see which part of the world is paying attention to this warning. Now, here's what's keeping serious investors up at night. The bond market is not behaving normally. Long-term yields are elevated, auctions are getting shaky, and the language coming from central bankers is shifting from confidence to concern. That shift in language is everything, because when the people printing the money start sounding nervous, you should be paying very close attention. Let me tell you exactly what I'm going to cover today. First, why the bond market is the real nuclear threat that nobody wants to discuss openly. Second, how a bond market panic could send silver violently toward $400 to $600 in a compressed timeline. Third, why gold breaking $10,000 is not fantasy but mathematical probability under certain conditions. And fourth, what you should actually do about all of this before the door slams shut. And yes, the description has important links. There's a premium WhatsApp channel for faster alerts, and a channel membership link for those who want deeper research from our separate team. Keep those bookmarked because later in this video, I'm going to explain why speed matters in what's coming. Now let me set the stage properly because most people fundamentally misunderstand what the bond market is. They think bonds are boring. They think bonds are for old people in retirement. They think bond yields are technical details that only economists care about. That mindset is about to become very expensive. Here's the truth. The bond market is the spine of the entire global financial system. Governments finance themselves through bonds. Banks treat bonds as their primary collateral. Pension funds are built entirely around bonds. Insurance companies park their reserves in bonds. When you understand this, you understand why bond market instability is not just another headline, it's a system-level threat. Think of it this way. Stocks are the face of the economy. Everybody watches them. They get the headlines. They get the attention. But bonds are the skeleton, and when the skeleton cracks, the whole body collapses. That's not metaphor, that's architecture. Right now, in the United States, the 30-year Treasury yield has been hovering in the upper 4% to low 5% range. That might not sound dramatic until you realize what it means for government finances. The U.S. government is now paying over $1.2 trillion per year just in interest costs. Let that sink in. Not spending on defense, not spending on infrastructure, just interest payments alone. And that number is growing every single month. In the United Kingdom, long-dated gilt yields have been bouncing around the 5% area with uncomfortable volatility. In Japan, a country that kept rates near zero for decades, officials are openly warning about rapid moves in long-term rates. The Bank of Japan is walking a tightrope, and the wind is picking up. Here's the question nobody wants to answer. What happens when investors start demanding even higher yields to hold government debt? What happens when confidence in the ability to repay starts cracking? What happens when the buyers disappear? The answer is simple but terrifying. Governments have two choices. They either default, which is politically impossible, or they print. And when they print to calm the bond market, they dilute the currency. And when they dilute the currency, hard assets get repriced violently upward. That's the connection. That's why bond market panic leads directly to silver at $400, $500, $600. That's why gold breaking $10,000 is not some fantasy number. It's what happens when trust breaks and money floods toward things that cannot be printed. Now, I'm going to make a prediction that might sound bold. Within the next 18 to 24 months, we will see a bond market event that forces central banks to intervene in ways they haven't since 2020. And when that intervention happens, it will be the starting gun for the most violent precious metals rally most of us have ever witnessed. Hold that thought, because in the next section, I'm going to break down exactly why the bond market is structured to fail. And I'm going to show you the specific numbers that prove this isn't fear-mongering, it's arithmetic. But first, let me ask you a question. Do you think the average person understands that their entire financial life depends on the bond market functioning properly? Comment yes or no below, because I genuinely want to know what you think. The disconnect between public awareness and systemic risk has never been wider. People are arguing about politics while the foundation underneath their retirement accounts is developing cracks. And when those cracks become visible to everyone, it will be too late to prepare. That's why I'm making this video now. Not when the crisis is obvious. Now, while there's still time to understand what's coming and position accordingly. Now let's go deeper into why the bond market is the sleeping monster most people refuse to acknowledge. And let me be clear about something. I'm not trying to scare you for clicks. I'm trying to show you the math that scares the people who actually understand this stuff. The United States government currently has over $36 trillion in national debt. That's not a projection. That's the current number as of early 2026. Now here's where it gets uncomfortable. In fiscal year 2025, the federal deficit was approximately $1.9 trillion. That means the government spent $1.9 trillion more than it collected in taxes. And that gap has to be financed by issuing more bonds. But here's the trap. When you issue more bonds, you have to pay interest on those bonds. And when interest rates are elevated like they are now, that interest cost becomes massive. The U.S. is now paying over $1.2 trillion annually just to service existing debt. That's more than the entire defense budget. That's more than Medicare spending. Interest has become one of the largest line items in the federal budget. Now think about the doom loop this creates. The government runs a deficit. It issues bonds to cover the deficit. Those bonds add to the debt. The debt generates more interest costs. The interest costs add to next year's deficit, and the cycle repeats. Each year the hole gets deeper. Each year the interest burden grows. And each year the risk of a confidence crisis increases. Let me give you a specific example of how this plays out. In 2025, there were Treasury auctions where demand was notably weak. The term tail in auction language means the Treasury had to pay higher yields than expected to attract buyers. When tails get larger and more frequent, it's a warning sign. It means the market is getting nervous about absorbing all this supply. Now imagine what happens if foreign buyers start reducing their purchases. China has already been trimming its Treasury holdings. Japan is dealing with its own currency pressures and may need to sell Treasuries to defend the yen. Europe has its own debt issues. The marginal buyer for trillions in new Treasury issuance is becoming uncertain. This is the scenario that terrifies central bankers. A buyer's strike. Not a total collapse in one day, but a gradual erosion of demand that forces yields higher and higher until something breaks. And here's what breaks. Banks. Regional banks in particular are sitting on massive unrealized losses in their bond portfolios. When they bought bonds at low yields and rates rose, the value of those bonds dropped. In 2023, we saw what happened when Silicon Valley Bank and others faced this problem. That stress has not disappeared. It's been papered over with emergency lending facilities. But the underlying issue remains. If yields spike again, bank balance sheets take hits. If banks get stressed, they pull back lending. If lending contracts, the economy slows. If the economy slows, tax receipts drop. If tax receipts drop, deficits grow. And the doom loop accelerates. This is why I call it nuclear. Because once this chain reaction starts, it's extremely difficult to stop without extraordinary intervention. And extraordinary intervention means money printing on a scale that makes previous QE programs look modest. Now, here's the part most analysts won't say out loud. The Federal Reserve knows this. They know they're trapped. They can't raise rates too much without blowing up the bond market and the banks. They can't cut rates too much without reigniting inflation. They're threading a needle while riding a unicycle during an earthquake. And when you're that trapped, eventually something forces your hand. Some external shock, some auction that goes badly, some geopolitical event that shifts flows, some moment when the market calls the bluff. That moment is the bond market panic I'm warning you about. And that moment is when silver and gold will move in ways that shock even the people who've been preparing. Let me share another number that adds weight to this. Central banks around the world added substantial gold reserves in 2025. The World Gold Council reported that central bank gold purchases remained elevated, with several quarters showing purchases in the 250 to 300 ton range. Russia, China, India, Turkey, and others have been consistent buyers. Ask yourself why. Why are central banks hoarding gold while telling the public everything is fine? Why are they quietly positioning for something while publicly denying anything is wrong? The answer is obvious if you're willing to see it. They're hedging. They're preparing for a scenario where the current debt-based monetary system experiences a credibility shock. They're buying the one asset that has no counterparty risk. And here's the cliffhanger for this section. If central banks are preparing for this scenario, why aren't you? If the institutions that print the money are buying gold, what does that tell you about their confidence in the money they print? Drop a comment and tell me what you think central banks know that they're not saying publicly. I read every comment, and your perspective helps shape future content. Now, in the next section, I'm going to connect this bond market time bomb directly to silver. And I'm going to show you why silver could be the biggest percentage gainer in the entire monetary metal space when this finally detonates. Now let's talk about the metal that's about to capture the world's attention, silver. And I need you to understand something that most investors completely miss. Silver is not just a precious metal, it's also an industrial metal. That dual personality is what makes it uniquely positioned to benefit from what's coming. Right now, silver is trading near the $100 level. To casual observers, that might seem expensive. They look at the chart, see that it's already tripled from years ago, and assume they missed the move. That assumption has cost more people more money than almost any other mistake in investing. Here's why. In structural repricing events, the early move is a warning, not the conclusion. When systems break, assets don't move 20% and stop. They move 200%, 300%, or more. And silver has a history of exactly this kind of explosive behavior. Let me give you the data that matters. In 2024, global silver demand hit approximately 1.2 billion ounces. Industrial demand reached another record high, driven by electronics, electrical applications, and solar photovoltaic manufacturing. The solar sector alone consumed somewhere around 200 to 230 million ounces of silver in 2024, depending on which estimates you trust. That represents roughly 15 to 20% of total silver demand from just one application. And here's the problem. Supply isn't keeping pace. The silver market has been running structural deficits for several consecutive years. Estimates for recent annual deficits have ranged from 150 to 200 million ounces per year. That means demand has consistently exceeded mine supply plus recycling. Now you might ask, if there's a deficit, why hasn't price exploded already? The answer is inventories. Existing stockpiles have been absorbing the gap, but inventories are finite. They're drawdown charts, not infinite wells. And when inventories get tight, the market dynamics shift dramatically. Here's another piece of the puzzle that almost nobody discusses. Approximately 70-75% of silver mine production comes as a byproduct of mining other metals. Silver is often extracted alongside copper, lead, zinc, and gold. That means you can't just mine more silver because silver got expensive. You'd have to expand copper mining or zinc mining first. The supply response is slow and complicated, so we have rising industrial demand, especially from solar and electronics. We have structural deficits eating into inventories. We have supply that can't respond quickly to price. And we have a bond market set up that could trigger massive investment demand on top of everything else. That's the setup for $400, $500, $600 silver, not hopium. Math. Now let me talk about the gold to silver ratio, because this is where the leverage lives. The gold to silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged around 50-60 over long periods. At extreme bottoms in silver sentiment, it has spiked above 80 or even 100. At extreme tops in silver excitement, it has dropped below 40 and sometimes below 30. Right now, with gold near $5,000 and silver near $100, the ratio sits around 50. That's already a significant compression from where it was years ago when the ratio was above 80. But here's the explosive potential. If gold moves to $10,000 and the ratio compresses further to 30 or even 25 during a mania phase, silver could mathematically reach $300 to $400. And if the ratio overshoots during peak panic, as it has in past manias, $500 to $600 becomes achievable. I know those numbers sound extreme. But extreme is what happens when systems break. Normal price behavior assumes normal conditions. We are not in normal conditions. We are in end-of-cycle conditions where debt has reached levels that cannot be sustained without currency debasement. Now let me address the skeptics, because healthy skepticism keeps you alive. Yes, silver is volatile. Yes, it can drop 15% in a week during shakeout phases. Yes, industrial demand could soften if we hit a severe recession that crushes manufacturing. These risks are real, but here's the counter. In a debt crisis solved by money printing, the inflationary force often overwhelms the recessionary force. Prices get pushed up in nominal terms even if real economic activity is weak. That's stagflation, and stagflation is where precious metals historically perform best. Let me also address the mid-move trap I've mentioned before. In past silver bull markets, there have been brutal corrections in the middle of the run. 1980 had multiple 20-30% corrections before the final spike. 2011 had several vicious pullbacks before the blow-off top. These corrections are designed by the market to shake out weak hands, trigger stop losses, and transfer metal from impatient speculators to patient accumulators. If you're not prepared for that volatility, you will get shaken out at the worst possible time. You'll sell the dip that should have been bought, you'll watch the recovery from the sidelines, and you'll compound the damage by buying back higher out of frustration. That's why I keep emphasizing psychology over price prediction. Your process matters more than your target. Your rules matter more than your hopes. Decide now how you'll react to a sudden 20% drop. Decide now whether you're holding for a multi-year thesis or trading for short-term moves. That clarity will save you when the candles get violent. Now, quick pause for those links I mentioned. The description has the premium WhatsApp channel link for faster alerts. It also has the channel membership link for members-only videos produced by our research team. If you want the deeper layer of analysis, those resources are available. I keep these mentions short because I respect your time. In the next section, I'm going to explain why gold breaking $10,000 is not fantasy. And I'm going to show you exactly what sequence of events could take us there faster than most people believe possible. Now let's talk about the senior metal, gold. The grandfather of monetary assets, the one asset that has survived every empire, every currency collapse, every financial crisis in human history. And right now, gold is setting up for what could be its most significant move in decades. Gold is currently trading near $5,000 per ounce. That's already a level that would have seemed impossible just a few years ago. But here's what most people don't understand. In real terms, adjusted for actual inflation rather than government-reported numbers, gold is not at all-time highs. It's actually still well below its 1980 peak when measured in real purchasing power. That tells you something important. Despite all the gains, gold has not yet had its true mania phase. It has not yet had the moment where taxi drivers are talking about it and your neighbor is asking how to buy coins. That phase comes later, and that phase is where the truly explosive moves happen. Now let me connect gold directly to the bond market threat we discussed earlier. When governments face debt crises, they have limited options. They can default, which destroys credibility and access to future borrowing. They can impose austerity, which is politically suicidal, or they can inflate their way out, which means printing money to devalue the debt in real terms. History shows which option they choose. They print every single time. Argentina prints, Turkey prints, Venezuela prints. And when push comes to shove, the United States and Europe will print too. They'll call it something else. They'll create new facilities and acronyms, but the effect is the same. More currency units chasing the same real stuff. And gold is the ultimate real stuff. It cannot be printed. It cannot be defaulted on. It has no counterparty risk. When you hold gold, you're not trusting any government, any bank, any institution. You're trusting 5,000 years of human history. Let me give you the math on $10,000 gold. In the 1970s, gold went from $35 per ounce to $850 per ounce. That's a 24x move. The monetary conditions today are arguably more extreme than the 1970s. Debt to GDP ratios are higher. Deficits are larger as a percentage of GDP. Unfunded liabilities are staggering. If gold made a similar magnitude move from its recent cycle low, $10,000 would be entirely achievable. But forget the 1970s comparison. Let's look at simpler math. Global central banks have been buying gold at a pace not seen in decades. In 2025, quarterly purchases repeatedly exceeded 200 tons and sometimes approached 300 tons. That's consistent buying from institutions with long-time horizons. They're not day trading, they're strategically repositioning. Now ask yourself, if gold is just a barbarous relic with no monetary role, why are central banks accumulating it so aggressively? Why did China add hundreds of tons to its official reserves over recent years? Why is Russia building gold reserves despite Western sanctions? Why are India, Turkey, Poland, and others competing to buy? They're preparing for something. They know something. And what they know is that the current dollar-based system is unstable. They know that debt levels are unsustainable. They know that when the music stops, gold will be one of the few chairs left. Here's another angle that adds fuel. De-dollarization is no longer a fringe theory. It's happening in real time. Countries are settling trade in yuan, in rupees, in local currencies. BRICS nations are actively discussing alternatives to the dollar system. Saudi Arabia has made statements about accepting currencies other than dollars for oil. None of this happens overnight. But the direction is clear. The dollar's share of global reserves is declining. And as it declines, the need for an alternative reserve asset increases. Gold is the oldest and most neutral option. It belongs to no country. It has no political allegiance. It's the Switzerland of assets. Now let me give you the timeline I'm watching. If the bond market experiences a genuine stress event in 2026 or 2027, the Fed will likely be forced to respond with liquidity measures. That might be rate cuts. That might be a new QE program dressed up with different language. That might be yield curve control, where the Fed explicitly caps long-term rates. Any of these responses involves money creation. Any of them dilutes the currency. And any of them sends gold higher because gold reprices to reflect currency debasement. In that scenario, gold doesn't just grind higher slowly. It gaps up. It has days where it moves $100 or $200 in a single session. It has weeks where it does what normally takes months. That's what happens when decades of distortion suddenly get priced in. And here's the part that makes this even more explosive. Western investors are still underweight gold. The percentage of financial assets allocated to gold and gold mining is near historic lows. When that allocation shifts even slightly, the gold market is too small to absorb the flows without significant price increases. Think about it this way. The entire annual gold mine production is worth roughly $200, $250 billion at current prices. The global bond market is over $130 trillion. The global stock market is over $100 trillion. If even 1% of bond or stock money rotated into gold, it would overwhelm the physical market completely. That's the mismatch. That's the setup. And that's why $10,000 gold is not fantasy. It's what happens when a tiny market gets discovered by a giant pool of capital looking for safety. Now let me ask you another question for the comments. Do you think Western investors will wake up before or after gold passes $7,000? I'm genuinely curious about your timing expectations. Drop your answer below. In the final section, I'm going to give you practical steps, what to watch, what to do, how to survive the volatility that's coming, and how to avoid the psychological traps that destroy most people during explosive moves. Now let's get practical, because knowledge without action is entertainment. And I'm not here to entertain you. I'm here to help you prepare for what's coming. First, let me give you the phases I expect to see over the next 1 to 3 years. This is based on how these cycles have unfolded historically and how current conditions are setting up. Phase 1 is the grind higher. This is where we are now. Metals climb with annoying pullbacks. The mainstream calls it a bubble. Weak hands get shaken out repeatedly. The professionals quietly accumulate. Most of the public ignores it or waits for a better entry that never comes. Phase 2 is the catalyst. Something breaks in the bond market, currency market, or geopolitical arena. The Fed or other central banks are forced to respond with liquidity measures. This is the starting gun. This is when the move accelerates. Phase 3 is the surge. Silver starts dramatically outperforming gold. The gold-to-silver ratio compresses rapidly. Daily moves get larger. Weekly moves start to look like what used to take months. People who ignored metals suddenly notice. Phase 4 is the shakeout. Right in the middle of the surge, there's a violent pullback designed to wash out leveraged traders and transfer metal from weak hands to strong hands. Headlines scream collapse. Panic selling happens, but it's a trap. The move resumes shortly after. Phase 5 is the blow-off. This is where prices do things that feel illegal. This is where your neighbor asks how to buy silver. This is where the daily candles are taller than some monthly moves used to be. This phase can last weeks or months, and timing the exact top is nearly impossible. Phase 6 is the aftermath. Eventually, the mania exhausts itself. Prices correct, sometimes significantly. Policy responses may stabilize the system temporarily. A new normal gets established at much higher price levels than before the crisis started. Now, what should you do with this framework? First, decide your conviction level. Are you 100% confident in this thesis or 50%? Your position size should match your conviction. Don't bet the farm if you're uncertain, but don't bet nothing if you believe this is real. Second, decide your timeline. Are you holding for the entire multi-year cycle or trading portions along the way? Both approaches can work, but they require different rules. Traders need stop losses and profit targets. Long-term holders need emotional discipline and the ability to ignore volatility. Third, prepare for the psychological warfare. The market will try to bully you into selling too early. The headlines will scream bubble. The comment sections will fill with skeptics and bears, and often, the day you finally sell will be the day before the next leg higher starts. That's not bad luck. That's how markets transfer wealth from impatient hands to patient ones. Fourth, have a rules-based approach. Decide in advance what you'll do if silver drops 25% in a week. Will you panic sell? Will you buy more? Will you do nothing? Having that answer before the event happens is crucial. If you're winging it, you'll make emotional decisions that compound your losses. Fifth, watch the signals I mentioned earlier. Watch bond yields and auction results. Watch currency volatility, especially in the dollar index and yen. Watch central bank behavior and language shifts. Watch the gold-to-silver ratio like a heart monitor. These are your early warning systems. Sixth, use the resources available. The description has the premium WhatsApp channel link for faster alerts when things move quickly. It has the channel membership link for members-only videos that go deeper on these topics. Those are optional but available for those who want the extra layer. Now let me address the community aspect, because you're not alone in this. If you're positioned in metals and doing well, share your story in the comments. Your success story could motivate someone else to stay disciplined during a hard pullback. One encouraging comment can make the difference for someone who's about to give up at the worst time. And if you're new here, introduce yourself. Tell me where you're watching from. Tell me whether you're stacking for safety or profit. Tell me what prompted you to find this channel. That information helps me create better content for what you actually need. Now, for the skeptics still watching, I understand the instinct to doubt. Big predictions often fail. Permabulls have been calling for $100 silver for years before it finally happened. Being early can be expensive. All of that is true. But here's what I'd ask you to consider. Are the conditions today the same as they were 5 years ago? Is the debt picture the same? Is the deficit picture the same? Is central bank behavior the same? If the conditions have changed materially, then the price implications have also changed. You don't have to believe me. Believe the math. Believe the central banks buying gold. Believe the structural deficits in silver. Believe the debt spiral that has no politically viable exit. The evidence is not hidden. It's just ignored by most people because it's uncomfortable. And that brings me to my final point. Preparation is not pessimism. Owning hard assets is not betting against your country. It's recognizing that systems built on debt have expiration dates. It's protecting your family against scenarios that history shows are possible. It's being prudent rather than hopeful. The door I mentioned at the start of this video is still open, but doors don't stay open forever. When the bond market stress becomes undeniable, When central banks are forced to act, when the public finally wakes up and rushes for the exit, that door will slam, and the people on the wrong side will wish they had listened earlier. Drop a comment with your timestamp, answer the questions I asked throughout this video, share this with someone who needs to hear it, and subscribe if you want to stay informed as this story develops. This entire video is for educational purposes only. I'm not your financial advisor. I don't know your personal situation. Nothing here should be taken as direct instruction to buy or sell anything. Use this information to learn, then make your own decisions or speak with a qualified professional. Thank you for watching. Stay alert, stay disciplined, and I'll see you in the next one.